if you had recommended any of your clientele or for your own self to get into credit risk funds at any point of time in the last 6 to 12 months, have the base conditions changed for you to consider making a switch? Part one. And if so, and if you would be moving out of it, why would you be doing that? Now, there are some hypotheses out here. You assume a moderate risk client with moderate return appetite and no specific goal in mind.
Sure. Well, thanks so much for having me on the show. It's a real pleasure to speak to you. Well, essentially, I haven't really recommended anyone to go into credit risk, but so I guess this is a hypothetical question. And essentially, I wouldn't be too excited about this space because, as Shalini mentioned, hindsight is a wonderful thing. And if someone's to take risk, my real thought process, at least to myself, would be to look at equity, because essentially you're taking credit risk to go into lower quality papers, and yet your returns will be capped at whatever they are. Also, you have to look at the global situation in terms of the macros and the headwinds. And it is likely, it's not a definite, but that earning qualities will reduce. Also got QT in terms of the Fed increasing and obviously other central banks following in tow. So again, these lower quality papers may or may not struggle to make these repayments. So rather than take this bet, and again, I'll have to face volatility possibly, I'd have to look at 3 to 5 years as a kind of holding period. And I'd be taking all that risk for probably not too much more than other standard and lower risk debt products. So if I really wanted to look at my portfolio as a whole, I'd rather go into equity ownership, because here is a real chance to be part of India's wealth creation. Again, we have to look maybe 5 or 10 years with the viewpoint that there may be near-term volatility. But here you're buying ownership in perhaps even quality companies, and your returns are not capped in many respects.